slots in between those levels, which is certainly the area to watch.
Do you see any impact on the relationship with China, or, I mean, how much are they going to be watching this issue as well?
Oh, look, China is going to be all over this. Obviously, they have a huge interest in our resource sector. And as do we. It works both ways. We scratch their back, they scratch ours. So look, China are going to be very interested to hear about what's going on over here, especially because our resources have been reacting so negatively to the press out of China. And so look, I think it's going to be very interesting to see what's going on, and certainly in light of yesterday's PMI data.
Yeah, well, I mean, the PMI data yesterday really spooked the markets. And even just in the space of the past week, suddenly it feels like there's these great concerns about the health of the Chinese economy. In some ways, it's quite good to be seeing that economy slowing down a little bit. Longer term, that's better in terms of being more sustainable for us. Do you think the concerns we've got right now, which are moving markets, are actually justified?
Now, that's a very good point, and it's one that I really want to highlight 2 points that I feel flow from this. One, PMI data, it was in expansionary territory. It was not dire. It was it was in line, slightly softer than forecasted. Now, what this is showing is there's a slight cooling of the economy going on over there. If we remember Q1 this year, they were growing at 12%. The GDP was growing at 12% annualised at totally unsustainable levels. Now, it's been well known and put out to the public that they need to cool this down. These inflationary pressures were there. There's property and asset bubbles going on there. There's no way that they could keep in line with that 3% inflation rate that they wanted for the full year. They needed to ease this back down. So it is actually somewhat of a positive that some of this data coming out there is showing a cooling economy. And the second thing I just want to touch on there is that if you look at, for example, Europe, which is China's biggest export partner there, the demand out of Europe is falling. We know that the demand in Europe is off. The consumer and the investor sentiment over there is weak at the moment. So for the manufacturing data and the manufacturing side to be slowing down in China somewhat reflects this supply-demand curve. It's sort of macroeconomics 101, and I think overall it's a positive picture. Let's not forget that the Chinese growth is still forecast to grow at 9.5% annualised for the second half of this year. So look, I'm bullish on the Chinese story.
But just on the European situation, I mean, the question is whether they recover, and the debate is whether all of the austerity measures will actually just put a complete handbrake on growth, and therefore China's obviously impacted, and then we're impacted. Do you give that a slim chance, though?
Well, look, that's exactly right. It seems that Europe sneezes, the world's catching a cold at the moment. Yeah. I think in terms of the austerity measures, yes, they are hampering growth. As I said before, it works both ways. Chinese need to slow down this growth in the economy there. A lot of these developed nations are looking for the emerging markets as really leading the world out of this global downturn. I think we have to obviously watch what happens in Europe. That's a real hotspot at the moment. But look, positive news flow out of Europe last night. There were some real positive things to pick up on there last night that showed the economy has got a glimmer of hope.
And just to finish off, we've been calling this mining super profits tax, just to bring it back to that. I'm not allowed to call it that anymore. It's got a new name. I'll get used to it. But the new tax, not necessarily a political comment from you, but from a market perspective, I mean, we've been calling this a battle between the government and miners. Who won it today, do you think?
Oh, look, I think at the end of the day, it's a win-win. I think that for the resources to have this nervousness somewhat removed around this tax, and the new name, Brooke, is Petroleum Mineral Resource Rent Tax. It's a bit of a mouthful, but I'm sure they'll find a good acronym for it soon. Look, the resources today, I think, will certainly have come out of the blocks well. They haven't rallied, and I haven't been at the desk, so I haven't really seen what's happened, but I think that they've come out quite, firmly. And how much did the market price in a positive outcome from this? I'd have to say that we were quite bullish that the Gillard government would come back to the table with something that was actually going to be more of a positive flow than the Rudd government had, because at the end of the day, it was a demise of or one of the key catalysts for the Rudd demise. So I'm bullish the resource story. I'm bullish the Chinese story. But saying that, let's remember the all-important payroll's out tonight. So it'll be interesting to see what investors want to do prior to the weekend.
And Al, some advice for everyone from Rudy Philippek Van Dyke, who joins us here on the Business Channel. He's from FN Arena. He says, minerals resource rent tax, every morning say it in the mirror, repeat it. That's the new term we have to hear a lot and speak a lot of from now on. So thanks very much, Al. Appreciate your time and your analysis. Thanks.
Thank you so much. Have a nice weekend.